This is Daybreak Asia. We're counting down to Asia's major market opens, just ahead of the start of trading for Japan and South Korea. But Paul, of course, just about 90 minutes out from the start of trade for China as well. And the question for those markets today is whether they're going to be facing any sort of reality check.
Yeah, that's true. We have seen a pretty decent rally for both the Hang Seng and the CSI 300 over the past couple of days off the back of the news of a 50 basis point triple R cut coming. But yeah, questions remain around the durability of that. Let's see if reality does start to set in, Bell.
And then I think it's perhaps a reality as well for the BOJ and what they're really seeing signalled in the inflation numbers, because we just had the services PPI coming out, but the Tokyo inflation numbers half an hour earlier telling a bit of a different story here. But the open for trading of the Nikkei, and at the start of the day, we are just going to be tracking those moves that we had in the Wall Street session. So very strong 6-day gains overnight that could translate across to the session so far. But as I said, that focus on those inflation metrics that came out in Tokyo inflation, really the one to track, because we saw it falling below 2% for the first time since spring of 2022. Tokyo inflation, a leading indicator for the nationwide level. Services PPI, as I said, pretty much coming in line with estimates. We are seeing that tracking around a 3-decade high, so something that could help the BOJ or be one of the things that it factors into its decision, even though those BOJ meeting minutes we just got out, reflecting, of course, the December meeting, but telling us that officials perhaps likely to wait until after the spring wage negotiations are complete before they start to shift away from negative rate settings. You can see here stocks coming online to the downside. Let's switch on, take a look at what's happening in Korea at the start of the day. Here, the focus is also coming down to earnings, and one of those to note is Intel, of course, because we had the numbers after the bell today. Just a very disappointing forecast for the current period, because they're saying that sales in the first quarter are going to be maximum $13.2 billion. That's about $1 billion short of what the Wall Street projection had been. Profit as well going to be falling. So just really a signal to us that company is still seeing a lot of weakness. Chip names or IT-linked stocks, very heavy concentration in what we see in Korea markets, and likewise those are coming online to the downside, and we see that Korean won weakness continuing to persist past its 200-day moving average, Paul.
Normally around this time, I'd be updating you on what's happening in Australia. The short answer is nothing. It closed for a public holiday, but we do have trading in US debt underway in Japan. During the US session, we saw yields falling, and that trend is continuing into the Tokyo session. Yield on the 10-year right now, 411.07. Perhaps motivated by the big beat that we saw on GDP, suggesting this soft landing narrative well and truly intact. Those GDP numbers, 3.3% on year for the fourth quarter for all of 2023, 2.5%. Personal spending in the US really remaining strong, and the economic strength in the US defying a lot of the bears, Annabelle.
Yeah, and Paul, let's bring in our next guest, or our first guest of this hour, Alex Wolf, Head of Asia Investment Strategy at JP Morgan Private Bank. And Alex, really strong start to the year for the Nikkei, and we've seen it gaining nearly 10% over this period, even though perhaps a little bit of weakness coming through in the session so far. Uncertainties, of course, around what the BOJ does and what we see in terms of any sort of normalization. But there's other factors that investors are very positive about, even though the market lacks breadth as well. So are you continuing to prefer it?
We, in the near term, we see it as both a near-term and a long-term story. In the near term, we think there could be some consolidation. It's run up a lot. You've seen very strong flows, particularly, say, outflows even out of the Hang Seng into the topics. And so it's also run up a little bit ahead of where we see fundamentals, both in terms of where we see earnings upgrades, somewhat disconnecting from where PMIs are. That said, over the long term, we do think that the corporate restructuring story is real. It will unlock additional value for investors, and we see many investors still underweight Japan, so we think that underweight could also gradually close. Even Japanese households are relatively under-owning equities. So we think structurally we do like adding, but adding more on pullbacks.
Yeah, it's interesting when you talk about longer term, because I think, when structural growth and you think of India, you don't so much think of China. So when it comes to Chinese equities, what's your long-term play there?
We're still selective. We think it's something that investors need to own. It's the world's second largest economy, very deep liquid market. There's always going to be opportunities. But it's just about being more selective instead of just buying it at the index level and expecting that growth to necessarily come through. Nominal growth has come down quite dramatically. Nominal growth is going to drive earnings. And we're looking at a fairly weak nominal growth outlook there, especially relative to India and many other economies in the region.
When it comes to the policies or potential policies that have been announced over the course of this week. It's really clear that policymakers want to get ahead of this to some degree. What's been your reaction so far?
Yeah, it does appear there's a new urgency, both to arrest some of the sell-off that you've seen in markets, but as well, the start of the year data has been fairly weak, fairly disappointing. So a newfound urgency, I think, to stem some of the slowdown. But it's still too early in that we haven't seen any really comprehensive either stimulus package or really comprehensive plan to address the property sector. So from our perspective, it hasn't been enough to really, in our opinion, rejuvenate confidence and bring about either a newfound bull market or really reaccelerate growth.
So maybe not a newfound bull market. If we sort of look at it from the other end of the telescope, have stocks found a floor yet in China?
That we do think they have. I think all of the stimulus measures and policies that we've seen announced, in addition to just the fact that they are quite cheap, I think that it likely limits the downside. And so we're looking at particularly offshore China as somewhat range-bound in the near term. We could see a pop based on short covering, based on reaction and improvement in sentiment to some of the measures that are announced, but see it largely range-bound, particularly on the offshore side. But that said, do see it capped on the downside, limited downside. And if we see additional measures announced, then could absolutely see upside. So we do still see it somewhat asymmetric, but more likely range-bound.
Do you have any concerns about the amount of debt being carried by Chinese companies?
Yes, but that's a long term. I mean, that's been a concern. I think when you look at the amount of overall debt, second only to Japan, most of that is held in local governments. A lot of that is held in SOEs. I think when you actually look at private corporates, the amount of debt, overall leverage has actually been coming down over the last couple of years. So I think on private corporates, particularly listed corporates, not that much of a problem. The problem is fairly concentrated, property, local governments, et cetera. That said, though, at the overall macro level, yeah, it is absolutely a concern, but more of a long-term growth concern.
What has been interesting overnight as well, we've got those US GDP numbers, and it just tells you that US exceptionalism, perhaps it can continue. It seems like markets or investors, the individual consumer is also withstanding higher rates as well.
Yeah, it's certainly been a surprise. I mean, it was even a surprise to Powell, I think, in his December press conference, in terms of seeing the economy saved by the supply side. You've seen a real increase in labor supply that has brought down wage growth, and the consumer, contrary to expectations, stayed quite strong. So you really are looking, at least by the fourth quarter numbers, at somewhat of this Goldilocks type scenario of strong growth, inflation continuing to cool. That is the big question, though. Does inflation continue to cool to the target, or does it stay somewhat stuck? But the numbers are definitely encouraging for the soft landing view for this year.
It's when you take a look at the stock market performance, because that run-up that we've seen really from October, stocks kind of seem priced to perfection at this point. What are you thinking in what we're seeing from earnings so far? Because it does appear a little bit like a mixed bag.
Yeah, we do think that earnings are, because we did go through quite a trough last year. So you have good comps in terms of, we saw across a number of sectors, earnings turn quite negative. We do think across the board we should see a positive return to earnings. We're more or less in line or slightly below consensus. Nonetheless, we do think that positive earnings growth that we will likely to see, especially across the board, can continue to drive equities a bit higher. That said, we don't see that much room relative to our target from where they are now, because they have run up a lot. But we do see equities going a bit higher, of course, of this year.
All right, Alex, thanks for your time this morning. That was Alex Wolf, Head of Asia Investment Strategy at JP Morgan Private Bank. Still ahead, a closer look at Intel's disappointing forecast as shares tumble in late trading. We'll have more analysis next. This is Bloomberg. You're watching Daybreak Asia. About 10 minutes so far into trading for Tokyo this morning, and a big mover just coming online here. You can see that drop for Renesas there at the bottom, down more than 5%. Now, Renesas, it specializes in chips for autos and other industries. And the big news that came out yesterday after the bell is that Hitachi and NEC are seeking to raise a total of up to $2.1 billion by selling off their stakes in the company. So it's going to be Asia's largest additional share sale so far this year. Of course, we're just in the first few weeks, but a very significant one to track. The two holders, they're offering 123 million shares at up to 2,528 yen a piece. So block deal that we saw the terms at Bloomberg News, but the price representing a 6 to 8% discount to the Thursday close here. You can see that drop in Renesas really reflecting the terms as well. But Japan's equity capital market certainly active since last year because shareholders or companies looking to take advantage of climbing equity prices. Also to note, if you change on now, is what we're seeing in terms of chip-related shares across the region. We had Intel putting out a disappointing forecast for the current period. It is the largest maker of computer processors, but it's tumbled, of course, in after-hours trading. We've seen Intel dropping more than 10% during this period. Other chip-linked names as well, we're seeing a bit of weakness coming through. But let's get more on that outlook now because we've got our Bloomberg intelligence analyst joining us here this morning, Kunjun Sabani. So, Kunjun, just talk us through what really stood out to you in the numbers.
Yeah, I mean, definitely the 1Q miss was the biggest thing that stood out. They had weakness in their non-core segments, which is PSG, the FPGAs, telcos, autos, industrial, and enterprise, which was a growing concern. But beyond that, we had expected the PC and the server, which is their core business, to sort of come to the rescue and offset some of that. And that didn't happen. Those are also guided to come at the lower end of the seasonality. So that's a little bit of a concern. But on the positive note, they did guide for the total sales to resume its growth trajectory after 1Q.
Yeah, Kunjun, also on a positive note, fourth quarter was a slight beat. So what were the drivers for that?
Yeah, the primary driver there was better client, which is their PC segment. For Intel, the 3Q, most of its older inventory was drawn down. So 4Q, what we saw is customers drawing down on the newer inventory from Intel, which is the core and ultra-core processors. And these are higher priced with higher ASPs. So it helped them get better revenue than we anticipated.
In terms of what Intel can have for future growth drivers here, we know they're developing their own processor. We don't have a lot of details on that. How concerned are you that Intel hasn't gone public yet with any of the large customers, possibly for its project?
I mean, it is concerning, but at the same time, nothing outstanding from what we expect. Look, they were behind NVIDIA and AMD, right? When you talk about the accelerators for the data center, and the $2 billion pipeline for a scale like Intel, it's still pretty small. For a similar pipeline for AMD is pretty large. So there is concern that there is lack of sort of big customer announcement, or even more than that, lack of a revenue trajectory as to how much of that pipeline we will see convert in this year or next year.
All right, Bloomberg Intelligence, senior semiconductor analyst Kunjun Sabani there. And stay tuned for an interview coming up with Intel CEO Pat Gelsinger for more on the company and the industry outlook as well. That interview coming up later on Bloomberg Technology. Just gets you across an alert on the Bloomberg terminal at the moment. LG Energy, the South Korean battery maker, out with fourth quarter earnings. Operating profit coming in at a miss, 338.2 billion won. The market was looking for more like 465 billion won. LG Energy saying 2024 capex, that's going to be similar to 2023 levels, and it's targeting a mid-single percentage revenue growth for 2024 as well. So a bit of a miss there for LG Energy. Shares in South Korea right now trading pretty much flat. Well, optimism over AI is fueling a seemingly unstoppable advance for Microsoft. The software giant closed the New York session with a $3 trillion market cap for the first time. Bloomberg senior editor Chris Palmieri joins us now. So, Chris, a huge amount of optimism around AI, what it means for the future of Microsoft. How much longer has this enthusiasm got to run?
Well, optimism in investors, maybe not in the media world, which is, in a panic about this. There's a lot of believers in this technology that it is going to change every industry on the planet. And so whether that comes to be or whether this doesn't live up to the hype remains to be seen. There's certainly a lot of questions about ethical issues, and we saw the Federal Trade Commission in the U.S. start an investigation into the AI companies today. So,
Yeah, talk us through more about how concerned you are by that FTC, and could we see more of these sorts of crackdown perhaps on monopoly power to come?
Well, there have been lawsuits, and they've had mixed success between Washington regulators and the technology industry. But this is definitely something that's going to continue. We've seen news media organizations sue about artificial intelligence. We've seen the Hollywood writers' strikes wrestle with this issue. So, the regulators investigating today have to be taken seriously. But we really don't know where this all ends, because there's just so many question marks about how this technology will impact our lives.
Chris, it's only been 3 months since Microsoft acquired Activision for $69 billion, and now there's a lot of layoffs happening. Tell us more.
Yeah, 1,900 people announced today, quite a big chunk of the gaming operation at Microsoft. It's funny, this isn't something that they talked about during this long, tortured acquisition process, where once again Washington regulators tried to prevent this acquisition from happening. It ultimately did, and now we're seeing the consequences. Not unusual for companies doing big mergers to do layoffs. Microsoft is implementing its strategy. We've seen some pretty senior people at Activision Blizzard leave today. We've seen games canceled, ones that have been worked on for 6 years, and we're seeing this throughout the video game industry as well, as these companies sort of refocus on their core brands and less on the sort of experimental projects.
Yeah, and in terms of cancellations, one of the big ones is Odyssey, which was a survival game, 6 years in the making. It sounded like it was going to be quite good, and now the plug's been pulled. Why?
There were a lot of issues with it. It was a complicated game, and Microsoft or Activision Blizzard had problems with the technology. Our colleague Jason Schreier has a really nice story out today with a backstory of it all. But games can be complex things, especially when you're trying to break new ground. And in this case, it just didn't work.
All right, that was Bloomberg's media and entertainment senior editor, Chris Palmieri. As Chris just mentioned, 3 of the biggest names in tech, Alphabet, Amazon, Microsoft, have received inquiries from a U.S. regulator about their investments and partnerships in AI. Bloomberg's Sue Keenan joins us with more from New York. And Sue, what exactly is worrying the FTC about big tech's alliances here?
Well, they want to make sure that the competitive landscape stays competitive, and they want more information on what appears to be a close-knit community and ties between old guard big tech and these very exciting new AI startups. The FTC making it clear they're closely monitoring the industry in a public workshop, with FTC Chair Lina Khan saying these AI companies, quote, cannot use claims of innovation as cover for law-breaking. Now, the FTC said it sent subpoenas to 5 companies to gather information. And what you're looking at here is bots from OpenAI, the maker of ChatGPT. They're playing video games. It's part of what generated enormous excitement in the market over the last 14 months. The probe is focusing on the more than $19 billion in investments by Microsoft, Amazon, and Alphabet's Google, and the series of transactions that appear to have cemented alliances between the world's cloud server giants and the leading developers of AI software. So the receivers of the subpoenas were Google, Microsoft, OpenAI, Amazon, and Anthropic. That is the 5th target. This is an AI firm startup that began in 2021 and was created by a lot of employees who left OpenAI and wanted to start their own firm. So again, there's concerns that some of the most promising AI startups are now depending heavily on a small group of very big tech firms for their financing and for their infrastructure needs, and the FTC wants details.
So usually the Justice Department conducts antitrust investigations involving big tech. So what's changed here?
Well, what's changed is perhaps a little bit of politics and a little bit of procedural authority that allows this to happen. We know at least one Democratic member of the Federal Trade Commission has criticized the tech giants for structuring their transactions, their huge multi-billion-dollar funding into the AIs, in a way that avoids the U.S. merger law. So they're not required to notify antitrust antitrust enforcers. The agency is using its so-called 6B authority to do what they call market studies to issue these subpoenas and gather information, and they also have the authority to then launch probes based on the information or to aid in existing probes by other agencies. Microsoft is reportedly invested more than $13 billion in ChatGPT maker OpenAI. We know that Google back in October committed to back Anthropic with $2 billion. Amazon last year also agreed to an investment of as much as $4 billion. So you're talking multi-billion-dollar investments, and the FTC wants to take a very close look. Back to you.
All right, Bloomberg's Sue Keenan there. We have plenty more to come on Daybreak Asia. This is Bloomberg. Blackstone shares gained after it reported distributable income of $1.11 per share, and that beat forecasts of 96 cents. President and COO Jonathan Gray told us he expects IPO activity to pick up in the second half.
What's happening in our business is we're benefiting from this regime shift. As we move from this rising cost of capital environment, which we saw under the Fed for the last couple of years, into an environment here where as inflation comes down, the Fed's easing, and that leads to a virtuous cycle for our business. Equity markets open up, debt cost of capital comes down, IPOs occur, M&A activity picks up, and that's very positive for our business in terms of a reacceleration.
A lot of your inflows really came in the credit space, but at the same time, John, there are a lot of investors out there who are worried that perhaps private credit is approaching bubble territory. The question becomes, are there enough opportunities out there to prudently put the money to work?
When you talk about things like a bubble in credit, what I like to look at is how much risk is there. And if you look at the loans we're originating in direct lending to private equity sponsors, on average today, they're about 40% loan to value. That's almost half of what they were back in the 06, 07 period when we had an actual bubble. Default rates in credit across our non-investment grade borrowers are less than 30 basis points. So we still see a very healthy market out there. What we do expect is that transaction activity will pick up and that folks like us in the private credit space are in a really great position to deliver for borrowers. If you think about what we do, we make loans to companies and hold them, either on behalf of our pension fund clients, it could be for individual investors in the form of BDCs, or in investment grade for our insurance companies, and we can deliver certainty to borrowers. And that is taking more share. And so I think what we're seeing is a structural shift towards private credit. It doesn't mean that we're seeing excesses build up in the system, as I said, because the fundamentals in terms of loan to value, credit quality still remain strong.
How do you feel about the opportunity here for M&A to move forward? You mentioned deals coming back, but the reality is we've only seen it in drips and drabs. How fast do you see yourself putting hundreds of billions of dry powder to work?
Our expectation is we'll see a pickup. And if you looked in our fourth quarter, you see some early signs of that. Our lending area saw more than a doubling in terms of new loans we were making. If you looked in our private equity area, we've been working on some of these transactions a long time, but in the last 6 weeks of the year, we announced 6 deals across the U.S. and Europe, many in sectors we like, digital marketplaces, enterprise software, energy transition, and in real estate, we also saw a pickup in activity, privatizations, a big distressed loan portfolio. So we are seeing a pickup. It does often take a bit of time, but things are starting to loosen. So it does feel like for M&A, a bit of an inflection point.
That was the Blackstone president, COO, Jonathan Gray, speaking to Bloomberg's Sonali Basak. And we are half an hour into the session, or just under, for trading for Tokyo and Korea today. Australia is shut for a public holiday, but there is quite a bit of weakness we're seeing across sectors here, with the exception of energy standing out, but certainly not tracking those gains we had for another day on Wall Street.
The consensus around the table of the Governing Council was that it was premature to discuss rate cuts. And in addition to that, I typically stand by my comments. We had to continue to be data dependent. So rather than being fixated on any kind of particular calendar, which would be being date dependent, we reaffirmed our data dependency.
That was the ECB President Christine Lagarde speaking after policymakers left interest rates on hold for a third time. A muted affirmation as well that came through from Lagarde that the ECB could start to cut rates from around mid-2024, but certainly taken by the markets as a signal that earlier moves are very much in play now. So we've seen traders really stepping up their bets that we could see a reduction in April and more than 140 basis points of easing over the course of 2024. And so that's really been playing into that dynamic. Euro stocks futures have just come online, and you can see here pretty muted so far, but perhaps looking to track some of the gains that came through in the Wall Street session as well, higher for a sixth straight day. What's interesting, of course, the key market we're tracking this week is China and these expectations around easing. Bloomberg Economics says the PBOC is just getting started when it comes to more stimulus, on top of the latest reduction that was announced early this week in terms of bank reserve requirements. So our China economy editor, Jill Desis, joins us now for more. And Jill, this is really what traders are wanting and banking on, but how much more aggressive do policymakers need to be?
So I think at this point, traders are certainly expecting them to get a bit more aggressive this year, although I don't really think that that's really the signal that we've gotten from the government as a whole. I mean, we just saw Li Qiang last week in Davos say that they don't want to roll out massive stimulus to help the economy. Now, on the monetary policy side, I do think what was really unusual about this press conference that we had from the PBOC governor this week was that he kind of front-ran this announcement of this reserve requirement ratio cut. Normally, you'd see another state agency kind of announce that first, and then there would be a bit more of a choreographed way of getting to that. The fact that he announces that in a press conference maybe symbolizes some urgency. I think what we'll probably see from the PBOC this year, maybe you see another couple of cuts to that ratio throughout the year. I know that Goldman is forecasting another one in Q2 and Q4, I think. I know Bloomberg Economics is also maybe seeing a couple more trims there. But then they also have to take that with this desire to kind of balance that with more structural tools that they may need to help the economy. The PBOC over the past couple of years, especially during the pandemic, has been really focused on guiding credit into very specific targeted areas that they're focused on: green energy, that kind of stuff. So it's really hitting that balance as we get in through the rest of the year.
Jill, we're going to be hearing from another policymaker, Xia Yonqi, the vice head of China's national finance regulator, a little bit later on today. What are we expecting to hear there?
Well, I think at this point, when it comes to finance in China, I mean, look, we're in the middle of this $6 trillion stock market rout. I think at this point, what people really want to hear from China is any kind of additional pledges that can really restore confidence in this economy, in the stock markets. That's really what we're looking for here, right? So earlier this week, we also saw the Premier Li Qiang, really stress to a lot of government agencies that they needed to do more to kind of put a floor under the stock market rout. We've seen that in the form of not just what we saw from the PBOC, but also from some other regulators this week in terms of vowing to kind of, protect things, stabilize things. I would think that we would want to see anything that really points to that idea of a bit more stability, whether it's, concrete measures, whether it's pledges. I think that anything that can kind of project that idea of, have confidence in this economy right now is really what people are going to be looking for.
All right, China economy editor Jill Desis there. Well, let's bring in Andrew Collier, managing director at Orient Capital Research. And Andrew, we just heard Jill there talking about policymakers' efforts to put a floor under these markets, restore confidence. We have seen the CSI and the Hang Seng both gaining over the past couple of days. Have they done enough? Is this rally going to be durable?
No, I don't think it will be durable. I mean, you've got a couple of things going on. You've got monetary easing through bond issuance and interest rate cuts. You've got some regulatory changes on the gaming front. And then you have this very odd rumors of a 2 trillion yuan stimulus injection into the stock market by state-owned entities, none of which has been actually proven or officially uttered. So, and then you have, as Desis just pointed out, you have Li Qiang standing up and making statements at a very high level about their intentions in the future. I'm seeing a lot of symbolic gestures. The monetary easing is significant. I would agree with that, because we've had 3 years of crackdown on the property sector, and this is the earliest part of the larger stimulus that we're seeing. But so far, the government has been very reluctant to open the floodgates because they're worried about more bad money going to local governments and going to the property sector. So, and the whole thing about the $2 trillion is just rumors at this point. And the idea of state buying of stocks is not necessarily the best way to rejuvenate the economy. You need to make structural changes when you have a structural downturn. So this is steps that the market takes on board, but I don't think it changed the calculus of a property market that's in a major downturn with massive amounts of debt and no easy way to get out of that.
You mentioned the need for reform. What needs to be done, in your view, to really restore confidence to markets and to investors?
Well, the property crackdown was a step in the right direction, because that's a bubble that's been propping up the government and local government revenues for the last 20 years. So that was good, although it's difficult to see how they're going to get out of that. The reliance on the state sector for growth, industrial loans are going out. A lot of those are going to state companies that are not very efficient. The property developers, the only ones getting money these days are state-owned property developers. And the centralization of policy in the Central Financial Work Commission, in the Politburo, means you've got a very sort of stiff regulatory environment. What you need to do is try to get money to the private sector, relinquish some of the crackdowns on the tech sector that happened a couple of years ago, starting with Ant Financial and Alibaba and some others, and let the small businesses flourish, because frankly they're much more efficient use of capital than the state-owned sector. But that's not something that Xi Jinping is really interested in doing.
It's also a lot easier said than done, I guess, because I think, yeah, you can have a triple R cut, but then at the same time, you've actually got to want to see loan pickup. And when you take a look at the credit numbers, I mean, the numbers, the demand for loans from households, from corporates, private corporates, is so weak. So what is it going to be really that sparks any sort of meaningful sentiment shift?
Well, you're right. It's pushing on a string. They're throwing the money out there and nobody's picking it up. It's difficult. The semiconductors has a future, but maybe 10 years from now. Electric vehicles and green energy is pretty small in terms of the overall economy. So you've got to find new growth drivers. There's no easy solution. You've got to let the market sort of get money. The problem is when you have at least half the credit going through the state sector, they're not very good at giving money to the private sector, because these are guys who have jobs. They don't want to lose them if they give it out to somebody who's not backed by the state. So I'm hoping that there's going to be what I call forced reform, which is essentially local governments are sitting there, their tax revenues down, they're watching massive defaults in the property sector, and they're going to push people out on the street and tell them, okay, we're going to give you, $100, see if you can start a business. This is what happened 20 years ago when China entered the WTO and 6 million people were unemployed. They had to go out there and try to find their way, and some of them did and some of them didn't.
And I guess just thinking about what you're saying there about finding new growth drivers, because you think about solar, you think about EV as well. These are all markets where there's a growing concern from Western democracies that China has too much of a monopoly. So how does that sort of work? When are we going to see some sort of diplomatic shift? Or is it that China continues to look for those other key markets, Africa, the Middle East, and try and tap future demand from there instead?
No, they can't do that. I mean, that's a very good point. I mean, EV's been a success story, although the province has wasted a lot of money getting to where they are now. But I do think that there's going to be a lessening of wolf warrior diplomacy. China desperately needs the U.S. dollar trading environment because they can't switch to the ruble or the yuan. There aren't enough players out there. And they're going to have to try to figure out a way to play ball with the EU in order to maintain auto exports at some level that's going to keep some of these companies alive. So I'm expecting some softening of the tone going forward, although that's not in Xi Jinping's DNA, but it may be forced upon him and the Politburo going forward.
Andrew, I just want to get your thoughts on debt as well, particularly the amount of debt being carried by local government financing vehicles, companies as well. I mean, we've seen plenty of defaults in the property sector by now. Are you concerned that we could see defaults broadening out into other sectors as well?
I do, and it's very funny because 3 years ago, if you'd said, gee, a lot of the property developers would default, everybody would have said, no, that's impossible in China. Recently, people said, you can't have a trust defaulting. Trusts are kind of shadow banks, and yet we've had Zhongrong Trust default. Now, the next thing to go is going to be these local government financing vehicles with about $9 trillion US of debt. And people say they can't default because then there'll be a collapse of the system. They will start defaulting. And the government has been pretty good about containing these things because they don't have tradable products the way we did in the United States in the mortgage crisis, and they can control the messaging. So I think we're going to start seeing this kind of piecemeal default filtering through the system, and that's what's happening so far.
I'm curious for your views on how much you think China actually cares, and I mean President Xi Jinping actually cares about the moves in stocks, because stocks just account for such a small amount of household wealth when you compare it to what's happening in the real estate sector. So do you really think that they are that bothered by actually trying to prop up equity markets?
That's a great point. I totally agree with you. I don't think they are that. I don't think Xi Jinping really cares, except it is a measurable optic that embarrasses him in front of the global audience. That's the issue. But that's why we're not seeing actual buying. We're seeing rumors of state entities buying, but we're not seeing actual habits yet. So it's unclear to me if they're really going to step in with the cash that the market is expecting.
All right, Andrew Collier, Managing Director at Orient Capital Research. Thanks so much for joining us. Just want to check in on some of the oil stocks trading in the Asia-Pacific at the moment. A bit of a rare bright spot on the markets that are up and running right now. We got Inpex S Oil Corporation better by 1% at the moment. Energy is the only sector in positive territory in Japan at the moment. And we have seen crude prices rally as well. We've got oil up on China stimulus, US stockpiles falling, and of course that ongoing tension in the Red Sea, helping to support energy stocks in Asia at the moment. We do have plenty more to come on Daybreak Asia. This is Bloomberg.
Taking a look at some of the movers so far, we're just under 45 minutes into the session for Japan and Korea trading. Australia's shut today for a public holiday, but Renaissance, one of the names we're tracking in particular. So this is a company that specialises in chips for autos and for other industries, and you can see it here off nearly 7% at this stage. What's happened is after the bell yesterday, Hitachi and NEC announced plans that they were going to be seeking to raise a total of $2.1 billion. So they're selling off their stakes in Renaissance to try and show up some more capital here. So the terms of the deal that was seen by Bloomberg was that they'd be selling them for up to around 2,500 yen a piece, and that price represents a discount of about 6 to 8% to the Thursday closing price. So you can see here, unsurprisingly, we are seeing Renaissance drop back down to that sort of level here. But Japanese equity markets certainly active since last year because companies, as shareholders, are seeking to take advantage of climbing equity prices. It's all about trying to raise funds, but Renaissance, one of the movers this morning. Let's change on, take a look at Asian chip-related shares because we also had Intel issuing a very disappointing forecast after the bell today. So the company is saying that sales in the first quarter are going to be up to $13.2 billion. You compare that to the average analyst estimate, it was about $1 billion higher than what Intel is saying could be the peak for the first quarter. So certainly some concerns here because Intel's really struggling to defend what was once a dominant position in data center chips. So we are seeing chip makers, again, under a little bit of pressure so far, Paul.
Well, let's have a look at some of the other corporate stories that we're following. LVMH sales rose at the end of last year in a sign of resilience at the world's largest luxury conglomerate. Revenue at its key fashion and leather goods unit, which includes Louis Vuitton and Christian Dior, jumped 9% in the fourth quarter. Overall, organic sales rose 10%, and that topped estimates. The company's CFO sees the business now normalising after a post-pandemic boom. We've learned Shein investors are trying to sell shares in private market deals that value the online retailer at as low as $45 billion. The firm achieved roughly $66 billion during last year's fundraising, but sources say sellers are struggling to find buyers. Shein is battling intensifying competition and regulatory scrutiny ahead of its anticipated US debut. JP Morgan CEO Jamie Dimon's moving some of his top lieutenants into new senior roles. The shuffle includes moving Jen Pipesack to oversee the corporate and investment bank alongside Troy Robar. It positions them for wider experience as Dimon prepares potential successors halfway through his 5-year retention package. A Brazilian judge has ordered BHP, Vale and their Samarco iron ore joint venture to pay $9.7 billion in damages caused by a 2015 tailings dam disaster. A resolution over damages would help ease the legal uncertainty hanging over the companies. The dam collapse killed as many as 19 people and contaminated waterways in 2 Brazilian states. Annabelle.
Well, Paul, Porsche says its new EV will prove so popular in the US that it won't be able to keep up with demand. It's just unveiled an electric version of its best-selling Macan SUV. We spoke exclusively to North America President and CEO Timo Resch about what he expects from the new model.
We are pretty sure that with the launch of the Macan Electric, we will pretty much not be able to cope with the demand, and definitely in the first year. I think there's definitely a lot of demand. A lot of people are waiting for a product like this. And this comes at a stage where the Macan, as we have it in the market right now, with the combustion engine car, has its most successful year in its history as of last year. So there's high demand for the existing platform. And I think a lot of people are looking for this new latest edge technology that does everything that the Macan already has going for it, even to a higher degree. So for that reason, I feel positive about it. And then we can really see in the year 2025 and upcoming what the real relationship between the ICE version and the BEV version will be.
Right.
In the first year, I think it's just customer demand driven and what we can supply from our factory in Germany.
So, well, exactly so. So you're supply constrained, right, Timo? You know that demand for the electric Macan is going to outweigh your ability to supply. When you are phoning your counterparts in Germany, how much supply are they able to guarantee you for that first year?
I can't go into details of numbers, but I think we are very much driven by providing usually always just one car less than the market is asking for. So this is what our flexibility also in terms of our production pipeline, having both of these cars come out of our factory in Leipzig in Germany, that gives us this perfect possibility to custom tailor our supply chain to the market demands. And for that reason, I'm sure we will hit the right spot, supplying enough Macan overall. And I assume in the first couple of months, there will be more demand than we can supply for the Macan BEV.
Who are you worried about out there? Is it the Cybertruck? You know, it's a higher spec, expensive model in the first instance that goes to the high net worth individual or the big spender? Or are you worried about the electrified offerings from some of your German peers, like Mercedes, for example?
I think in terms of design and appeal and technology, really being cutting-edge technology, we as Porsche can usually have a lot of people that start being convinced and being excited about the Porsche brand. So we see that there will be a lot of opportunities to get the Porsche family growing, but at the same time also get existing Porsche fans excited for the Macan BEV. So there's, I think, a lot of opportunity in the still growing BEV market where customers will come from and start joining the Porsche family and start this experiencing what the feeling of the Porsche product is all about.
Timo, America was critically important to Porsche in 2023, in part because China's growth was decelerating. And I think Porsche has said 2024 is going to be difficult in China as well. What kind of pressure are you under to keep the growth going here in the United States, North America more broadly, when a key market like China is slowing down?
Being responsible for the North American market, I would like to focus on these topics. But if you see the overall balance of distribution of sales of Porsche, I think the Porsche brand is perfectly balanced in terms of its international distribution of sales. So this is a really, let's say, great time to see that there is not such a huge dependency on the Chinese market as it might be for some other brands. And we see the brand being in a very good position. I think we have high desirability. You can see that in all different kinds of studies. And for that reason, I also see good possibility to continue on this growth pattern of sustainable growth, also here in the United States or in the North American market overall. So we will, I think, driven by customer demand, continue the success story.
That's Porsche North America CEO Timo Resch with Bloomberg's Ed Ludlow. Coverage continues on Daybreak Asia. This is Bloomberg.
All right, we're just about over half an hour away now from the start of trade in Hong Kong, mainland China. Let's get more on the outlook. Bloomberg Markets co-anchor David Ingles is joining us. And Dave, I mean, 3 days of gains, but maybe not setting up for a lucky four.
Even if we don't get a lucky, let's say we get a lucky four.
Okay.
Let's say we get a lucky four. We'll still need 912 days on the Hang Seng China Index to get back all the way to peak, right? Now, there is some science to this number we're coming out with now. I'd also say that take it with a grain of salt. This is not a NASA-esque, algorithm telemetry that, this is the day we're going to land on the moon and this is the exact spot we'll land. But so what we're using, the methodology we're using here is we're looking at the individual price targets for each Hang Seng China Index stock. You're getting that consensus, and then you were implying an index upside over 12 months. We're assuming that's correct. We're taking that, which is about 47% over the next 12 months. We're assuming that's another 47 on top of that, and then we just extrapolate how long do we then get before we get back to north of 15,000, and the date currently is July 26, 2026. So we'll need to be patient, Paul.
Well, we did make it, David. It is Friday. What's caught your eye and what's been a pretty eventful week?
Yeah, well, caught my eye is not sleep, certainly. We do need a lot of that following what's really been a cracking week for these markets. As Bell was pointing out, 3 days of gains. You probably won't get a day four, but who knows? We're looking at several, perhaps, events today that could move the needle. You're looking at a market metric of volumes, for example, in turnover. The spiked yesterday's trading activity, nearly 900 billion yuan in the onshore market. I'd also point out there's a Ministry of Commerce briefing taking place later today where we could actually get something following the PBOC briefing that we got, also in the afternoon session midweek. Back to you guys.
All right, David, all the action at the top of the next hour. That was David Ingles, Bloomberg Markets co-anchor. And that's it from Daybreak Asia, leaving you here with a look at the outlook for Chinese equities over the course of the session today. And as we said, lucky four doesn't seem to be appearing. 3 days of gains setting up for a little bit of weakness here across the board.